The United States depends on one thing to survive. Not taxes, not economic growth, but a single assumption that someone will always be there to buy its debt. Every week, the government goes to market and asks for money. And every week, someone says yes. Foreign governments, banks, pension funds, the Federal Reserve. They buy the debt. The system keeps running, and nothing breaks. But here's the problem. That system only works if the buyers keep showing up. And for the first time in decades, there are signs they might not. Because behind the scenes, something is changing. The United States now owes over $36 trillion. And every year, it spends nearly $2 trillion more than it collects. That gap doesn't disappear. It gets financed. New debt, new buyers, new promises. Over and over again. That's the system, not law, not economics. A rolling agreement that the next buyer will always be there. And if you want to understand how systems like this actually break, not when they look weak, but when they look strongest, subscribe now. Because what happens next only makes sense once you see the full pattern. And for decades, that pattern held. But the reasons they kept buying are starting to shift. Foreign governments are pulling back. The Federal Reserve is stepping away. And the buyers replacing them care about one thing: price. Which means the entire system is becoming more fragile at exactly the moment it's issuing more debt than ever before. So the real question isn't whether the US can borrow money today. It can. The real question is, what happens the moment demand weakens and the buyers stop showing up the way they used to? Because when that shift happens, it doesn't stay contained. It spreads across markets, across currencies, across the entire global system. And by the time it's visible, it's already too late to stop it. To understand why the buyers matter so much, you have to understand the machine they're keeping alive. Every year, the federal government spends more than it takes in. In fiscal year 2025, spending came to roughly $7 trillion. Revenue, taxes, fees, everything came to about $5 trillion. The gap, nearly $2 trillion. That gap doesn't get erased. It gets sold. The Treasury issues bonds. Investors buy them. The government gets the cash it needs to keep operating. Those bonds are a promise. Pay us now, we'll pay you back later, with interest. Simple enough. But here's the part that changes everything. The Treasury market moves $1 trillion every single day. It is the largest, deepest, most liquid bond market on Earth. And that size is the entire reason the world trusts it. Foreign governments park reserves in it. Pension funds use it as a safety anchor. Banks hold it as collateral. The whole global financial system uses US treasuries as its foundation stone. But size and trust are not the same thing. Size is a fact. Trust is a choice. And the system only works as long as buyers keep making that choice. When they do, yields stay low. Borrowing stays cheap. The deficit stays manageable. The math works. When they don't, yields rise. Borrowing gets expensive. On $36 trillion of existing debt, expensive means catastrophic. The math breaks. And right now, the three groups holding this system together are all becoming less reliable at the same time. That's not a coincidence. That's where this story gets serious. For decades, the anchor buyers of US debt were foreign governments and central banks. China, Japan, Saudi Arabia, South Korea. They accumulated treasuries as part of their foreign exchange reserves. Not because they loved American debt, because the dollar was the world's reserve currency, and holding dollars meant holding treasuries. It was the price of doing business in the global system. At their peak, foreign governments held roughly half of all US public debt. That share is now around 32%. Still large in dollar terms, approximately $9.2 trillion. But that's a shrinking slice of a much faster growing pile. And it's not just the percentage. The nature of who's buying is shifting. Official buyers, central banks, finance ministries are stepping back. The demand replacing them is coming from private investors. Hedge funds, asset managers, chasing yield. That matters because private investors behave differently. A central bank holding treasuries for geopolitical reasons doesn't sell when yields get uncomfortable. A hedge fund does. Meanwhile, some governments aren't just buying less, they're actively moving away from dollar reserves. Russia after sanctions. Several Middle Eastern nations diversifying into gold and other currencies. China's treasury holdings declining over several years. The shift is slow, but it's consistent. And consistent trends in a $36 trillion market have consequences. The second pillar, domestic institutions, pension funds, money market funds, insurance companies, banks. By mid-2023, yields were rising, and money market funds poured over $1 trillion into treasury bills. Domestic demand stepped in, where foreign official demand retreated. That's what kept the market stable. But domestic buyers are price sensitive in a way central banks aren't. They're not holding treasuries as a geopolitical statement. They're holding them because the yield makes sense. The moment something else looks better, the math changes. They move. They are participants, not anchors. The third pillar, the Federal Reserve itself. For 15 years, whenever the Treasury market needed support, the Fed was there. Quantitative easing, asset purchases, trillions of dollars of direct bond buying to hold down long-term rates. The ultimate backstop. Then in 2022, the Fed reversed course. Quantitative tightening began. It let bonds mature without replacing them. Between 2022 and mid-2024, the Fed's Treasury holdings shrank by $1.3 trillion. The backstop withdrew quietly, without crisis. But the private sector now has to absorb a larger share of new issuance at exactly the moment foreign official demand is cooling and the government is issuing more debt than at any peacetime point in American history. Three pillars, all three weakening simultaneously, and underneath all of it, the debt keeps growing. The cracks aren't theoretical, they're already visible. Interest payments on the national debt crossed $500 billion a year, not the principal, just the interest. And that number is growing at roughly 8% annually, faster than almost any other line in the federal budget, faster than defense spending, faster than Medicare. The cost of carrying the debt is becoming one of the largest expenses the government has, and it compounds every time yields rise. In April 2025, something briefly broke the surface. Long-term Treasury yields jumped sharply, roughly half a percentage point in a matter of days. No default, no crisis, just a moment of doubt. Investors briefly questioned whether Treasuries deserved their status as the safest asset in the world. It passed, but the mechanism was visible. The Congressional Budget Office projects public debt rising from roughly 100% of GDP today to 118% by 2035. In 2025 alone, the Treasury needed to issue roughly $2.15 trillion in new marketable debt. More supply, weakening demand, rising yields. That's not a forecast. That's the current state. Every percentage point added to yields means tens of billions more in annual interest costs on future issuance. At $36 trillion of existing debt, the math accelerates fast. The budget gets squeezed, spending gets crowded out, the government's options narrow. And here's what nobody says clearly enough. The system has no mechanism for reversing this. It only has mechanisms for managing it. As long as the buyers keep showing up, management works. The moment they don't, the management options disappear quickly. What does that actually look like? Walk through it. These are the cracks. Not failures, not collapses. Cracks. The kind that spread slowly, then suddenly. A treasury auction goes weak. Not failed, not catastrophic. Just weak. Fewer buyers. Lower demand. The price drops. Yields spike. The bond market reprices in real time. The 10-year Treasury yield, sitting around 4%, doesn't creep up. It jumps toward 6, toward 8, and at that point, it doesn't stay in the bond market. Mortgages are priced off Treasuries. They reprice overnight. Car loans, business loans, corporate bonds. Every form of credit in the system adjusts simultaneously to the new risk-free rate. Companies that were viable at 5% borrowing costs aren't viable at 9%. Defaults follow. Layoffs follow. The credit contraction spreads from Wall Street to the economy within weeks. Banks hold treasuries as collateral, as the foundation of the entire system. If those treasuries suddenly lose value, the collateral loses value with them. Lending slows. Credit tightens, and every institution recalibrates its risk at the same time. We've seen a version of this before. In March 2020, Treasury markets briefly froze during the COVID panic. Not for days, for hours. And it nearly broke the global financial system before the Fed stepped in at a scale never seen before. That was a few hours. This version wouldn't stop there. So the Fed intervenes. It always does. Bond purchases restart. Massive ones. Trillions of newly created dollars flood into the system to stabilize prices and restore liquidity. Markets calm. The immediate crisis pauses, but the money is already in the system. Inflation accelerates. The dollar weakens. Investors who stopped trusting treasuries now have less reason to trust the currency those treasuries are denominated in. They move toward gold, toward euros, toward assets that hold value outside the dollar system. Each dollar that flows out of treasuries pushes the dollar's purchasing power lower. Lower purchasing power makes the fiscal position look worse, which reduces confidence further, which pushes yields higher, which forces more printing. The loop closes on itself. Higher yields, more printing, more inflation, more doubt about the dollar, more selling of treasuries. Higher yields again. This is not speculation. This is the described mechanism of every sovereign debt crisis in history. The names change. The currencies change. The mechanism doesn't. The United States is not the first country to believe its currency was permanent. History is full of systems that looked just as stable, until they weren't. In late 18th century France, the government issued the assignat, paper money backed by nationalized land. As long as people believed in that backing, it worked. The moment that belief cracked, the currency didn't decline slowly. It collapsed. Within just a few years, it was worthless. Then came Weimar Germany in the early 1920s. A modern industrial economy, a sophisticated financial system, a government issuing debt it couldn't sustain. Inflation turned into hyperinflation. Savings evaporated, and within a decade, The economic and social fabric had torn in ways that took generations to repair. Then, Britain after World War II. For over a century, the pound sterling had been the world's reserve currency. Not because it was forced, because it was trusted. Britain had the deepest capital markets, the largest trade networks, and the institutional credibility to support it. Then came the debt, the inflation, the slow erosion of its fiscal position. What took 100 years to build unraveled in less than a decade, and the dollar replaced it. The pattern is always the same. A currency keeps its reserve status as long as three things hold: political stability, responsible fiscal policy, and institutions willing to make difficult decisions to protect the currency. When even one of those starts to weaken, the exit begins. At first, it's slow. Capital moves quietly, without attention, without headlines. Then it accelerates. And then it happens all at once. The United States still has real advantages: deep capital markets, a highly liquid currency, and global influence that supports the dollar. Those advantages are real, but they need to be maintained. They depend on consistent decisions that protect long-term credibility. Every delayed deficit reduction weakens that foundation. Every political pressure on the Federal Reserve does the same. These advantages don't disappear overnight. But trust doesn't stay constant. It fades. And once investors begin to hedge against the risk of the dollar losing its role, that hedge starts to drive the outcome. Capital moves out of treasuries. Yields rise. Higher yields weaken the fiscal position. A weaker fiscal position increases the risk investors are trying to avoid. And once that cycle begins, it feeds itself. There is no imminent collapse. That needs to be said clearly. The Treasury market worked last week. It will likely work next week. The buyers showed up. The system held. Nothing broke. But the conditions that made this system feel unquestionable are starting to shift. Quietly, consistently, in the background. Foreign demand is slowing. The Federal Reserve has stepped back. Deficits are larger than at any point in modern peacetime history. Interest costs are rising faster than anything else in the budget. And in April 2025, we got a brief glimpse of what happens when doubt enters the system. The system doesn't need panic. It only needs enough people to decide, quietly and rationally, that there are better places to put their money. Better stores of value than a bond issued by a government running multi-trillion-dollar deficits with no clear plan to stop. When that shift spreads, yields rise. Borrowing gets more expensive. The budget tightens, and the government faces a choice it has avoided for decades. Cut spending enough to restore confidence, or print enough to replace the demand that disappears. History is consistent about which path gets chosen, and it's consistent about what comes next. The entire system runs on one assumption: that someone will always be there to buy the debt. They always have been, until they aren't. If this made you rethink how the system really works, subscribe. Because this isn't just about debt. It's about the structure holding the global economy together. And what happens when that structure starts to fail?